Good morning, everybody. Thank you for joining us. This is going to be a pretty informal presentation, and we also ask that you participate as well. So as we're moving through things, feel free to throw any questions at us. What we'd like to do first, we'll start now with Bill at the other end, is introduce ourselves, tell a little bit about who we work for, what we do, and then we're going to launch into the discussions if we can, please. So.
I'll give the abbreviated one because if you grab one of my cards on the way out, it says Meet Bill, you'll learn more about me. So, Bill Smith, that's a real name. I've been in lending for 10 years now. Born in Ann Arbor, in Saline, and with the Bank of Ann Arbor, and also on the Board of Realtors Educational Committee and the Board of Directors as well. Thank you for coming.
I'm Amanda Lawrence. I'm with John Adams Mortgage. I've been there for 9.5 years, and the co-chair of the Education Committee of the Board.
Good morning, everyone. I'm Jeremy Shaffer with Ann Arbor State Bank. I've been with the bank since 2008 when we opened, and prior to that, big, huge bank, and then Republic Bank when they were around town. I also am on the Education Committee with Bill and Amanda, so welcome and thank you for all coming.
I'm Bill Holmes with Ann Arbor Mortgage. Been in the business for 30 years. Also part of the Education Committee, that's why we're all here, and are looking forward to sharing some information with you today. What we thought we'd do is we've got a couple of pieces of paper in front of you. One is a pathway from essentially start to finish, and the second are some tips that we had come up with as a group, also with some input from some of the other members within the Education Committee. So I guess we're going to do this quite informally, as I said, but I think what we'd like to maybe do first is talk a little bit about the state of the business and what is happening from our end and how it impacts you and your borrowers. And I guess I'll start with that if I can. Business has changed immensely over especially the last 3 or 4 years, and even the last 2 or 3 days probably. Yeah, all of you have been in it for quite a while, I imagine, from looking around the room, and have seen underwriting requirements become very strict, appraisal requirements be doing the same thing, and it's not letting up. The CFPB and the Dodd-Frank and all these different names have acronyms have had a huge impact on our business and how we can pass things on to borrowers, relate to them, and share things with you that have had an impact that's not always been what we would like to have. So I'm going to pass it on down. We'll talk a little bit each about some of the things we're seeing on that and then walk you through the steps.
I think the biggest thing that I've noticed in the conversations with underwriters and the change in the last few years is, of course, we're underwriting and looking at loan applications for risk, and that's always been what we've done, sometimes better, sometimes worse. But in the last couple of years, the focus, especially with Dodd-Frank and the Consumer Financial Protection Bureau, now we're doing a lot of what we're doing with the applications and the files is for compliance reasons. It's for compliance and it's for liability down the road. With certain provisions of Dodd-Frank and the CFPB, if you don't get the loan right, perfect as a lender, there could be litigation down the road when a buyer decides that they can no longer afford the home and then claim that you failed to prove their ability to repay the loan and you're in front of a judge. So that's what a lot of the changes have been lately. So again, I've spoken to a lot of underwriters that say, I'm turning into a compliance auditor as much as I'm turning into as I'm doing the underwrite for risk. So a lot of the silly things, a lot of the additional documentation. I think Forbes just did a report that the average mortgage file from origination through servicing is 500 pages. So that's a pretty good stack of documents that have to be handled, whether it's from origination on our side, to closing with the title company, to post-closing audits, and to posting over to servicing. So that's a big driver of what you all are dealing with as a result. Again, not necessarily purely for risk, but for liability and for compliance.
One of the other things that has caused some questions is the changes with Dodd-Frank at the beginning of the year. And just to reiterate that most of those changes impact our side of things, not necessarily yours. There were a lot of concerns that came up from realtors about how that would impact your business. And it's more of a conservative approach on our end with numbers and compliance issues that we have to deal with, opposed to anything that you guys need to worry about on your side of things. So keep that in mind as far as what the changes have been. There was a lot of talk about it completely changing the business. I think we can all agree that we haven't seen a huge impact on our business because of the new regulations that went into place. It's more of just more paperwork on our side of things rather than anything that would take care of, anything you would need to take care of on your side.
One thing that's a little bit tighter because of compliance and auditing and so forth is things that you and us and even the underwriter think are common sense, like deposits and things like that in bank accounts, which you could clearly see from a statement that the one account was transferred to the other and we could track it and see the $1,000 or $2,000. Now we have to document the whole entire paper trail. Their name has to be on the account number, sometimes stamped, you know, by the bank or credit union where it came from. So all of these things which fall on us, but one thing we have to try to explain to the customer and sometimes the realtor, sometimes clients have more than enough money in liquid assets to buy the house. But if they're, as Bill was talking about, if their debt ratios are higher, and even though they have that liquid money, it could come back on us later because we didn't document everything to have their ability to repay in line. So even though somebody, you know, we all deal with it. Make a long story short, people know how to manipulate the system, and they could be even testing lenders and banks to set us up or you up to fail, knowing down the road they're going to take advantage of this, you know, new law and regulation, and whether or not they would win a case in court or we would get, you know, hauled in. None of us want our names or our banks or lenders' names in the news, whether we, you know, win or lose or not. It's just not worth it. So that's why we're taking all these steps up front. So just, I ask, keep that in mind when you're dealing with your clients. We're not the big bad lenders and we're not being a pain and all that stuff. It's just stuff we have to follow as we were talking. So.
Yeah, with that being said, I guess what we're here for is to help you make your transactions go smoother, and it's a cooperative thing. I think one of the most important things is managing expectations. You need to let the seller know and the buyer know, everybody involved with you. There may be some delays that are unforeseen. We've seen the more strict appraisal requirements. Fortunately, we're coming out of an era where we had low appraisals and are hopefully going to not have as many problems as we did in the future. But I think just letting everybody know what may be expected as we move through the system, that we will be coming back and asking for more. I quite often joke with my borrowers that you're going to hate me by the time this is over with. That I'm going to be asking you, I'm going to know more about you than your mother, than the IRS, than anybody. But it's all part of what it takes to get from A to Z in the mortgage maze. So if we ask for something, we've already argued it. We've argued it behind the scenes. We know that we're not going to get any further without going to the borrower and saying, please clarify this, provide a letter of explanation, provide that extra sheet of paper. And one of the things that always pops up with us is a borrower provides us with something that leads to another question. So what we're running into recently is a spate of people, we're asking people to provide letters of explanation on things, and they're elaborating too much. They're, oh, by the way, we're thinking about getting a new car, or it's like we have to step back and ask them to perhaps rewrite that letter so that we don't open another can of worms. But we as lenders cannot let something go that we know something about. It's called fraud by omission. So if we are provided something and we don't provide it to an underwriter, and that could have a negative impact on that loan whatsoever, we have trouble, as does the underwriter. Once they see it, they can't say, I didn't see that, and set it aside. So we have to glean through everything that comes from the borrower, from you, from the appraiser, anybody involved, title company, to make sure that what we're giving is something that's not going to jeopardize the deal, or if it's going to lead to more things, that we try to be proactive and ask for some of the supporting documentation up front. That being said, I think what we're going to do is we'll start with our steps and kind of take you from the beginning. As we go through these, we're going to refer to some of the top tips on the streamlining transactions page on things you can do in various steps along the way to get us from start to finish smoothly.
I think every lender that is in this room and up here on the panel would be much happier if we are talking to your clients as soon as possible in the process. You can tell the client they don't have to do their mortgage with whoever you refer them to or whoever they're getting pre-approved through. But I think time is our best ally. Time is our ally when it comes to talking to a first-time buyer who is just starting to think about buying and figuring out what they can afford. We can identify possible issues. Time is our ally when we get into the transaction. We can solve so many problems if we have a couple more days or a couple more weeks. So the sooner that they can talk to a trusted lender that you know or that they know, the better off we're going to be. There's nothing worse than getting that phone call. We made an offer on a house, we need to get a pre-approval letter. And we need to get it by tomorrow. Now we all up here can turn around and sometimes in a matter of hours. But what if there's that little wrinkle? So time is what I would suggest is our best friend for all of us here in the room. And once we've done that pre-approval process and they're working with you and they've made their decision to buy to look at homes, that's typically where once they find the property, we have to start issuing our disclosures. So on a pre-approval, we don't know what home they're purchasing, we don't know the specifics. So we're simply going through the steps of making sure that they're going to be credit qualified on the basis of what we know now. Once they find the home and you put an offer in, that's when we are on the clock to issue our disclosures that are required by the state and the federal government and the various investor agencies that we work with. And then, and that's really, like, again, where the real rubber meets the road as soon as those disclosures are issued once the home has been found. And in that same time frame is usually when those inspections are being done. So.
Yep, and one thing also, when we do the pre-approvals, and it is relatively generic as far as what property, we don't know what property. Another thing I always tell my clients is when they do find a house before they write an offer, I want to review that particular property with them as far as the sale price, the association dues, the taxes, because they fluctuate so much. So if you say, you're good up to about $300,000, but then they flip and decide to purchase a condo and there's association dues involved and the taxes are non-homestead, it changes the whole picture. So we want to make sure that they are pre-approved to purchase that particular property. So I always ask before they write an offer to call me. I'll review the numbers real quick while they're submitting or at the office. We know that they're good to go on that particular property. After we take the application, after they find the property, that's when our timeline starts ticking as far as we want to get the appraisal done as soon as possible. So if there are any issues, we can get those issues addressed. We're gathering documentation nonstop throughout the process. We try to get as much of it as we can up front. I always ask for the bank statements and all that information when I talk to the client at the first time I talk to the client, so that if there are any issues on this application, we can address that before it gets into underwriting. So we're gathering documentation after the application is taken, and then the file's going into underwriting. That's when we wait. Sometimes it's a couple days, sometimes it's a little bit longer, depending on what type of a program it is. And then as soon as we have our underwriting approval, we contact the clients for whatever conditions are needed, and we reiterate to them that time is of the essence for everything at this point, because the longer it takes them to get us anything, the longer it's going to take to get the final loan approval.
So the important thing too about, you all have contingency dates on the purchase agreement. So we do our best to meet those contingency dates. If we can't, we let you know as soon as we can. So maybe you need to extend that contingency date, or we have to prepare for a delayed closing, something like that. But I know all of us here, we do that as quickly as we find out. One thing I can say with some of these conditions Amanda was talking about, we're constantly asking for things. If something that we get from the client a little bit later than we expected or we'd like, we want sometimes to employ your help. Maybe you can help encourage them to gather those documents. So kind of take that as we're teaming up to get your help to get everything to the finish line. That's the goal there. So back to what Bill said, they provide their homeowners insurance. Sometimes your debt ratios and things like that, like Amanda was saying, that could tip it off. We could be estimating an average of $600 or $700 per year for premium for homeowners insurance, and because of either A, where they're at, or because of the price of their wedding ring, or all these different things they have in there, they could jack their home insurance up another $400 or $500. Doesn't sound like a whole lot, but sometimes, especially if we're working on an automated approval system and the new ability to repay, they could tip it just over that debt ratio, where now we may have to look at it. They may need a little bit more money, which then of course that's going to require another documentation, you know, where they get the money from, maybe now they need a gift letter. So there's all these little things that we need to make sure that, you know, we have everything right before we get the clear to close, which is the magic word we all look for. Another thing too is for repulling credit. It's not a hard inquiry on a credit report, it's called a soft pull, but we need to make sure, and as we all tell our borrowers in the very first meeting and conversation is, do not buy anything, do not do anything different in your banking. We will make everything even keel all the way through. Otherwise, you're going to have to supply more documentation, you're going to have to verify things, and it just makes it difficult for everybody. So we want to make sure there's no new debt. So even like if you go to Art Van or Gardner White and get 500 years same as cash offer they have, a lot of people think, well, the payment doesn't start until, you know, 2,252. So, but there's an automated payment that is going to show up on their credit report, and that can really jack their debt ratios and exclude them from being reapproved. So just keep that in mind. We're not being nitpicky. We're not being a pain. We're working with you. We're all basically paid the same way, just like you, when the loan closes, so we don't do this just for fun. We want to see that loan close. I'll stop there and let Bill finish up the last there.
Contingency dates. When you are writing an offer, please call the lender if you have the ability to do so and ask what time frame should we be putting in there. As we mentioned in here, a borrower putting 30 or 40 or 50% down is probably going to go a lot smoother than the RD borrower, the person with zero down, the VA borrower, perhaps the FHA borrower. There may also be some things in that borrower's profile that they may be self-employed, that as of 3 weeks ago they hadn't filed their income tax. Things like this that may pop up. So please, if you can, speak with the lender and find out what time frames may be best for financial contingency and closing. The other thing I would also suggest is within our sales agreements now, we have borrower agrees to apply for the loan and a cause appraisal to be ordered within X days of final acceptance of the offer. Do not put 4 days. A borrower makes an has an offer accepted on a Thursday. That means by Monday we have to have all that stuff done. Chances are the borrower has not even contacted us till maybe Monday morning. With everything getting busier, I would suggest, I would imagine others, put 7 to 10 days on there. These are not business days, these are calendar days. And the last thing you want is a borrower who may drag his feet, or we have an issue where we cannot order an appraisal up front, or the borrower's out of town and can't get in to finalize the application. Last thing you want is to have your deal fall apart in the first 4 days because the borrower couldn't make those contingency dates. So please check with the lender and extend that time frame if you can. Again, it's managing expectations, letting seller and buyers both know that if things are busier, there may be some delays, and just the sheer volume of things starting to move through the small pipe may cause some extra time being needed. Another thing we always would suggest too is when you write the offer, take 10 seconds and go to USPS.com. Lenders want the address to be what USPS.com has in their system. If it's a street, if it's a road, if it's a boulevard, if it's none of the above, please take 2 minutes and go to that site and put that on the purchase agreement so that as things flow, it will be the same all the way through. Otherwise, we may be coming back asking for an addendum, adding street to the name. It's a pain in the neck for everybody involved, but it's one of the things that we have to be cognizant of, and if you can do that up front, it will make it easier too. Also, put a single man, a single woman, husband and wife. Let us know. Title companies will appreciate that as well. So many people today are married with different last names. We need to know that, as does everybody all the way through. And also try to get the same iteration of the name. Johnny B. Smith could be J.B. Smith, it could be John Smith. Let's try to maintain the same flow all the way through. When we're pulling credit, we may have had a different thing that shows up on the credit report. Sometimes that may necessitate a repull of a new credit report. So again, follow this tips, at least those first couple things on there, and that'll make the beginning portion of the process a lot smoother.
If I can just touch on that for
Please.
when you're taking the purchase agreement as far as the names, if they have already told you, or you already know, or we've conversed that even though it's a husband and wife, only the wife is going on the loan, the husband's not going on the loan, or vice versa, then only the person that's going on the loan should be on the purchase agreement too. Otherwise, we'll come back asking for an addendum to remove, and all parties have to sign, so.
Question?
Should we be using their name that's on their driver's license, or?
Ideally, that would be best, because we have to have photo ID per the Patriot Act, and if that matches all the way through, it's going to be a lot smoother. So, thank you, that's a good point.
Usually it's their name, when I ask is, how's your name on legal documents?
Mm-hmm.
You know, if it's Jonathan, I'll call you John, but it's best if that's not, you know, John's not the PA, Jonathan's on the mortgage, and he's got JD on the driver's license. So we really have to have it all flow.
And if you're doing deals out in Stockbridge and Gregory, there have been post office and street name changes, so they may say something, but they're gonna start sounding confusing to you, and I think that's a great suggestion, getting to go to this USPS.
That's how we do our mortgage application. So once we have an accepted offer, before we print out the application, we verify the street address through the USPS. So
Yeah, their street address, right, of that
exactly.
buyer, right.
So whatever the street address of the subject property is, that's what's gonna be on the mortgage application. So if you can take that extra time to check it, or when we're doing the pre-approval, ask us to check it, I'm happy to do that also, and I'm sure anybody else would be as well, to verify that street address so the purchase agreement does match the mortgage application.
You're right, even in town, we have someone will swear to me, it's Drive. Well, it's a street by the USPS. Well, I'll always put Drive on, well, that could be, but it's the USPS.
And some condos actually have the unit number in the actual address.
That's a great point.
Yes,
So that does have to be on there, so we're always asking for addendums to add the unit number, if it's part of the actual postal service.
And please find out who owns the property.
Yeah.
You'd be surprised how many times we get something and that person doesn't own it. If it's owned by Fannie Mae or Freddie Mac or some other entity, we need a power of attorney type of letter that states so-and-so who has signed this purchase agreement has the legal authority to do so. And one of the things that we all have to do is check everybody that's involved in a transaction. Buyer, seller, you, title company, appraiser, surveyor, everybody has to be checked through Data Verifier, one of the other systems out there. So the more information you can supply up front, the less problems there could be as we move forward.
Everybody's name gets run through OFAC, Office of Foreign Asset Control. Occasionally we'll have a name pop up, not because the person's on the bad list with the government, but because they just happen to have the same name. And then we have to go verify it. An instance last week where I actually had to contact listing agent to contact their seller to get a copy of the seller's driver's license to prove that Jennifer Smith in Ann Arbor, Michigan was not the Jennifer Smith in California who was on the government's watch list and do not do business with list. It does happen, and if it happens in the middle of a fast-turning transaction, it can cause a lot of heartburn. So it's not us, it's those that govern what we do. I want to jump back to the thing about the bill brought up about contingencies and putting enough time. I talked to a lot of the realtor partners who say, oh, can't you just order the appraisal? We have certain compliance rules that say I can't move ahead with ordering the appraisal and collecting the fee for the appraisal until I have taken the full application and disclosed the certain documents within so many days. So there are certain times where 4 or 5 years ago, sure, all of us up here, you give us a call, yeah, we'll get that appraisal order right now, we'll worry about the paperwork on Monday. We don't have that luxury anymore because of some of the new rules that were intended to prevent and to be for the better, but in reality have gotten in the way in a few transactions and leaving people that might not know why scratching their heads going, well, how come that lender isn't working with us on this? How come they're not moving fast? Well, we'd love to, but we just have to be able to get that buyer these documents, and like Bill said, if they're traveling, if it's over a weekend, we might not be able to fulfill that requirement, so we can't take that next step legally. And so our hands are sort of tied there. And I want to touch on one thing with the purchase agreements while we're on that subject. Personal property on a purchase agreement has become a very hot button with the agencies, Fannie Mae, Freddie Mac, HUD, FHA, the auditors. Even if it's something as simple as a couple of kitchen chairs. I know it makes no sense. It'd be nice just to say they have no value, but it opens up a whole can of worms. So it will help you if personal property is involved. You have a separate bill of sale or a separate document that doesn't even become part of the purchase agreement that I get my hands on when I have to start moving that loan through the system.
Yeah, washer, dryer, things of refrigerator, those are acceptable. But when you get into those other things that somebody could probably take with them, and they most likely would, you know, a hot tub is an issue too. So as Jeremy said, we would rather not see it, I guess is how we'll leave that.
Yeah, I put in built-in speakers that were in a house, and it was an issue. We had to take pictures, we had to prove,
And what their
we
value
had to
was.
prove that they were built
Yeah,
in.
built-in's okay, but yeah, sometimes I had one with a generator, and I had to prove it was a whole house. Actually
Yeah.
installed, not one of the portable hunted, you can pick up and put in the back of your truck. Otherwise, you're gonna open up a whole other can of worms that would probably fill a half-hour discussion on its own, the why and the how, and is it right, is it wrong? They look at personal property as a potential sales concession, and they want us to get a valuation for it, and remove that valuation from the price and the appraised value, and it turns into a whole mess.
One other thing that we want to just mention is for the purchase agreements, sometimes nowadays everything is done fax, email, scanner, etc. And by the time they're sent back and forth between buyers and sellers, they become illegible. And so it's difficult for us and our appraisers to read the documents when we get them, and then the investors at the end of the game to be able to read them when we pass the loan on. So make sure that you have legible copies. So if a copy is being sent to you and you can notice that it's become illegible, try and address that before it gets any worse. Typically we can take an illegible copy that we can make sense of what it says as long if it's fully executed, and attach maybe a copy that's not fully executed with it to match them up. But that, all disclosures, seller's disclosure, lead paint, any addendums, purchase agreement, make sure that they are legible, because from all the times that I had one the other day, pictures were taken because the seller was out of the country. So they took a picture with their iPhone and emailed picture by picture. So by the time those are sent back and forth, and it's a mess. So we can't read any of it, so now we have to kind of go back and get a new purchase agreement drawn up, which is more work for everybody. So resolution, the resolution that you send documents on also can make a big difference, and you can just maybe note that when you're sending stuff through email and fax.
I don't think any of us would be opposed to just meeting you for lunch. You buy us lunch, we just physically, and then we can scan it. That, no problem.
Great point. Let's check where
For lunch.
So I have a question. Many times out in the townships, people aren't taking their lawn tractor with. So what you're suggesting is that lawn tractor no longer goes as personal property, it goes off on, you don't ever want to know about it.
We know
Yes.
nothing.
Okay. Wow.
Yeah.
Exactly.
Or we'll want an addendum removing it if it is on the purchase agreement. We'll have to show that there's an executed addendum removing it, and it's just one more thing for people to sign.
Well, speaking of addenda too, the board realtor sales agreement talks about if you're doing an FHA VA, that the FHA and VA addendum are attached. I can't tell you how many times we see that check and we don't have the FHA or VA addendum when we get the purchase agreement. And the call's made and we go, oh yeah, we forgot to do that. Well, again, that can hold us up on some of this stuff. So please make sure that you are using the FHA and VA addendum. It's the same language for all of us. The board has it, I believe, on zip forms, if I'm not mistaken, so you can get it through that. But and make sure, again, it's signed. DocuSign in some instances is a problem. In most cases, it's becoming more the norm. But occasionally, we may find an investor that when a material change is made to a purchase agreement value, that they may want a wet signature on it. And again, we've argued it. Please just cooperate and try to see if you can get that from the buyer and seller and whoever else may be part of it.
Speaking of VA loans, is it true that VA does not allow you to put a compliance fee on?
That's correct.
Okay,
You
so
cannot-
you cannot show up.
You cannot show up, you can't be, yes, you cannot do it, yes.
And Amanda mentioned, making you have an addendum to remove personal property. I was just about a month ago on a conference call with a mortgage insurance provider, and we brought up that subject. And in the past, and I can't speak for every lender here, in the past I was able to get away with the addendum saying that's removed. The mortgage insurance head risk officer made the statement that their opinion is, if they've seen it on the purchase agreement, their opinion is that the agreement was negotiated and the price arrived upon with those terms. So an addendum removing it, saying, oh, never mind, it's not there, is no longer going to work with them. Now, I can't speak for every investor, every lender here. I can speak for our bank. We are just advising folks to keep it off altogether.
That's true of if you put the tractor on too, isn't it?
Absolutely.
Absolutely.
Yes.
Right.
Personal property that's not physically attached to the house. Now, like you said, we can take pictures and argue built-in speakers and win that. We can win the whole home generator. We'll win the argument, but we won't win it on a couple dining room chairs anymore, unfortunately. Just where we are with things. But yeah, let's go over the addendums.
Yep.
I did want to bring up one item that I've seen lately is if you happen to have a property that's on a private road or a shared driveway, I'm getting more and more conditions from underwriting for the private road maintenance agreement. Now, if it's in a condominium, a PUD, usually they're in the bylaws, not a problem. If it's not, you hope that there's an agreement out there, otherwise you run into the issue where, oh, we've lived here for 10 years, we've never had an agreement. We just work with the people on our street and, well, there's gonna have to be an agreement drawn up. And they're asking the appraisers to comment on the condition of that road. Now, that's usually not an issue either. But just be aware on private roads, that's coming up, and on a couple shared driveway situations in the last year or so, I've seen them ask for a shared driveway agreement as well, which in some of these homes that maybe have been owned for 10 or 20 years, and the same folks have lived in that same 4 or 5 house shared driveway, they've always just done it on good faith. We wish we could still operate in that world. Unfortunately now, when your new buyer comes in, chances are that lender's gonna have an underwriter say, where's the shared driveway agreement? Keep that in mind. It's a somewhat unique situation.
How in-depth do these agreements have to be? Can it be a signed piece of paper where everyone says we're willing to do this informally? You know, like, does it have to be a legally drawn up?
Ideally, it should be something that can be reported
Yeah.
to go for the future. That's the problem we've had in the past. It's not something that's been going along with the title of the property.
And many title companies have those forms that you just have to fill out, but we do suggest that, we suggest that you have an attorney, talk to an attorney about it, but there are forms out there available. on their
Yeah,
website.
it's one of the ones I struggle with the most, and I've argued because I say, hey, if these folks are happy with their neighbors and the neighbors say it's all good, why would it matter? But it all comes back to liability, and you get that the Fannie Mae's of the world go, well, that one person gets ticked off and doesn't hold up their end of the bargain, files litigation, and it could affect the status of our collateral, which is the subject property home.
Yeah, and speaking of attorneys, power of attorney, if you know a power of attorney is going to need to be used at some point throughout the process, we need to know ASAP. The investor needs to look at it, the PMI company may need to look at it. Don't say the day before closing, oh, she can't be there, he's going to give a power of attorney. You won't be closing the next day. So please try to get that to us and they need to be specific power of attorney, not general that so-and-so can sign for whatever issues the wife or husband has deemed necessary. So please let us know as soon as possible so they can be reviewed.
There are instances with Fannie and Freddie owned properties where the buyer is responsible for paying the transfer taxes. So, as you know, Fannie and Freddie have their 18-page addendums that go to the purchase agreements. So just make sure when you're reading those over with your clients to look at that, because that can be a significant change in their funds at closing. When we pre-approve them, those funds typically are not included in the numbers that we use because they are, generally speaking, seller paid expenses. But there are situations where the bank will not pay them and they're passed over to the buyer. So just focus on those, the verbiage in the purchase agreements if you can, when you do have bank-owned properties, so we can disclose that to your buyer and they know up front and can determine whether or not they can afford to purchase the home with the additional costs.
Yep, and then to go along with that, when you're dealing with the rural development loans, you know a client is going to buy a home and hope to use rural development loan programs. They better have checked with the lender first to make sure it's within the income limits, first of all, because there's some very specific income limits that apply to a number of folks in the household, working in your child care expenses, a lot of complexity there, but also make sure the property, because I think we all can agree, I've seen across the street's eligible and the other side of the street's not on that. So just because you've sold a property that was in that same neighborhood and was already eligible last month doesn't mean the next one will be, so it'll save us a lot of trouble if we double check, or if you don't have the time you're on the road with them, call one of the lenders and we'll check it for you really quickly. It's pretty easy to do.
Same as condos, sorry. VA and FHA, excuse me, condo financing, the condo development has to be approved to be able to get a VA or an FHA loan within that complex. So there are ways that we can look that information up for you. So if you want to call us before you write an offer, we can check to make sure it is a complex that is FHA approved, for instance, if that's what your client's been pre-approved for. And then VA, I know I've said this in my office several times, but with VA financing as well, site condos can be an issue. The subdivision has to be approved. So if you have VA buyers, it's always a good idea to run the specific property past the lender before you get into a contract, so you know that that particular property is not going to be an issue.
Yeah, I'll comment on that as well too. On VA, both FHA and VA have approved lists that you can go to through their websites. It's a little, when a condo is approved for FHA, it's on the list for 2 years. When it's approved for VA, it's on the list forever, unless something arises that would cause them to pull it off. As you look through VA, for example, Broadway condominiums. Broadway condominiums don't show up on VA, but if you put in the Broadway condominiums, they do. So Austin Commons 1, Austin Commons 2, there are various, look at all the iterations of a complex, and again, like Amanda's saying, we can certainly help you in trying to determine if it's going to be a complex that will work in, but they may have different spellings of their names or different suffixes. Other thing too, quickly on VA, then I have to forget here. VA has certain costs that the veteran cannot pay. And 2 of them that I think we all have, at least for sure, are going to be the pest inspection and the title company closing fee. There may be others that lenders have that are not allowable. Some lenders may have a doc prep fee, an underwriting fee, an admin fee. Those are also not allowed to be paid by the veteran. So again, if you can, talk with the lender, or borrower's lender, before you write the offer, so that those things can be put into the purchase agreement. If you want the seller to pay for some of those things, put it in there. If it's not designated, then there can be some issues on who's going to pop for all this. And we've all dipped into our pockets to make that happen. We don't like doing that. You can also participate. We don't like you having to do that either. But somebody's going to have to pay for that stuff, or we don't close. So again, check with the lender if you could.
I like that term, participate. I was just going to say, back to the condo, even if you do, or we help you check the site for the condo for FHA or anything like that, keep in mind those are not up to date by the minute, so it is lagging information. So we may get a condo questionnaire that comes in and find out, now guess what, there's too many rented units in there, puts it over the max 10%, or other things, their master policy, not the proper coverage. So when that gets submitted, that could get declined, and then you have to look at other lending options.
It's changed dramatically, don't you think, over the past few years?
Well, so many complexes allowed too many renters because they couldn't sell, so all they did is turn over rentals, and when you get above X% for 30% for a conventional loan, you're done. FHA is more lenient, but a lot of complexes, though, that had FHA don't realize that 2 years elapse and you're done, you're off the list. So they let their certification drop, and it's really a disservice to both their sellers and people trying to buy within the complex. But some of them just can't be approved anymore because of either too many renters or too many people having not paid their association dues, or a variety of things.
We're starting to see with some site condominium subdivisions that the agencies are starting to scrutinize the homeowners associations there. Not to the same level of a traditional attached condominium, but asking for, do they have the liability insurance? And that's been a big one, and most do. Most carry, even though there's not necessarily significant common areas, most do. And also fidelity bond, which means the person that collects the $200 a year from every homeowner, are they bonded in case they decide to jump up and run away with the money? So I know it's the silliest thing in the world, and would it really impact that community of detached title site condominiums? Probably not. But this is what we're hearing when we talk to the agencies and are on the conference calls with the Fannie Mae and Freddie Mac risk officers and those that set the rules. Somewhat detached from reality, I think. And Michigan is a little bit unique because we do have more detached site condo subdivisions than anywhere else, I think, in the country. And those of us who have been in lending for a while have fought that battle numerous times with the various companies and banks we've worked with in the past, and had some success, but I see that coming back as something that they're starting to scrutinize again. So it's good to know that something for the HOAs to be educated on as well.
Sure. Does anybody have any questions or anything, concerns within the industry that you want to ask about or talk about? Certainly answer some questions.
Quick question on appraisals, which I know could be a whole nother topic and panel. But I've always heard about once in a while, often an underwriter might come back and ask for more information from an appraiser. Are you guys seeing or hearing of underwriters sort of flat out rejecting appraisals these days? Obviously values are jumping. Is that something that we should be really concerned about or not too much?
Bill?
When you say rejecting, what do you
Just
mean?
an underwriter not necessarily agreeing with an appraiser on the value. Is that something that
I haven't seen it rejected. Sometimes they'll ask for maybe additional comps.
Supporting
Maybe the comps don't support the value they came up with. Because on an appraisal too, you have to have at least one comp that's higher and then others, so it has to be bracketed is the term. So maybe sometimes some of their adjustments, may be off to get that bracketing, if you will. But other than that, I've never seen it flat out rejected.
We'll have like a desk review, which is basically like a second opinion. If it's ever in question for value, we'll have to get a desk review done on our end just to verify the value. Generally speaking, I haven't had a ton of issues with value. I know. But one other thing with what you were saying is that when somebody does put a larger down payment on the home, and I think we kind of touched on like a 30% loan being a little bit more easy as far as getting through the process than something with mortgage insurance and something that might require extra steps. When you have a larger down payment, right now in this market, people are overbidding for properties, so they're paying more than what the list price is and competing to get the house. So if an appraisal does come in a little bit low and they have a larger down payment already built in, there's a little bit of wiggle room there, so we can still keep the mortgage insurance off the loan because they have about 10% left to play with if they want to use some of their funds and still finance the home and keep the sale price at the higher amount and agree to move forward with the lower price value.
Also seeing more appraisals come in with 9 or 10 comps. The appraisers are really trying to do that because they've all been badgered by underwriters wanting that additional comp or two. So they're going hopefully above and beyond to try to support that value. And I've seen some appraisals that have come low where the appraiser flat out said, here are 9 or 10 comps. Yes, we realize that things are starting to move up, but it's a hard time to get you to where you need to be. So they're always willing to look at new information and take a look at it. But I'm not seeing anybody necessarily flat out rejecting, as Matt's saying either.
It's helpful, and when we have meetings with appraisers interaction, I tell them, tell the story, paint the picture. Underwriters sitting in an office somewhere just looking at a piece of paper and looking at data because they pull automated evaluation data, they pull public record data. Tell the story, and that's where you as the realtors come in. When you meet the appraiser at your listing, or the appraiser calls you to ask about a comparable they're going to use that was your listing, provide the color behind it, provide the detail. There was multiple offers. This house was recently updated, had a brand new beautiful kitchen, highly efficient furnace put in, all the things that can help them tell the story of why that purchase price went to the level it did. And that does give a little bit more emphasis on the market conditions because the data is backward-looking data. So right now we're looking at comparables that sold in the last 3 to 6 months maybe aren't quite where a home that just is on the market on in that sweet spot price range today that's going to have 6 or 8 offers hit compared to that same home if it had gone on the market back in January when it was 10 below and 10 inches of snow on the ground. So it's helpful because the data is backward-looking if we can help the appraiser tell the story. And that's why hopefully the appraisers are willing to listen when you meet them at the property. And I think most of the local ones are.
What about surveys? In the old days, I never did a deal without a survey. And then all of a sudden, we didn't need surveys. Oh, well, okay, it's optional if the buyer wants it. Now, they seem to be coming back.
Well, title companies have a lot to do on that too. You know, do they want them? Are they needing them? We'll see some title commitments that say survey is required or survey is not required.
Yeah, so it's basically a title question then. That's
Well,
where
I guess
it
the
goes
title people in the
back.
room,
Yeah.
what are your,
Most of our underwriters do not require a survey, and I think, again, it goes back in the day, it was just the norm that
Yeah,
on the
it was.
lending end, it would be ordered. For a title company to insure the mortgage, the loan policy, it's not required because we're insuring different things for the lender than we are for on the owner's policy. So we typically use an affidavit in lieu, just to say that since they acquired the property that they haven't made any structural changes. And you can usually tell if there was anything that may have occurred in the past, survey-wise or boundary-wise, that's probably gonna appear a matter of public record. So we don't usually ask for it unless it is new construction or abuts water.
And we do, you'll see it on our commitment, if you're asking for a policy without standard exceptions, you'll see survey or the affidavit. So, and usually the affidavit is signed at closing and you don't have to worry about it, so.
some borrowers just want one.
I don't blame
Right.
you.
You know, it's just like, at least they
Yeah.
know roughly what my line is and
When you
where
think
you
of the
trade
money.
us and Consumers Power can come through.
Yeah,
And,
yeah, I think it's a good idea.
yeah.
They are also required, like Melissa said, on lakefront and new construction, but also on Michigan, like for MISHDA financing. So if the buyer is
Yeah,
getting a
okay.
MISHDA mortgage, then a survey would have to be done.
Okay.
Sir?
Can you comment on flood insurance and the lending process?
Well, Congress managed to screw that up royally. Probably, I mean, of all the things they've done that were silly in the last couple of years, the flood insurance, they really stepped in it. And recently have stepped back out and passed a law to fix it, but it's been a huge issue. The bottom line is make sure you know, we will do a flood cert, which means we check to make sure the property, the appraiser does, it can absolutely completely change the debt profile and the liability monthly because of the cost. But it's better than it was 6 months ago when the government tried to fix the subsidized flood insurance program. And I think we were just remapped by FEMA in the last couple of years, so we shouldn't have to worry about any changes for a while. But we've had issues where someone says we're not in a flood zone and the map says they are. Elevation surveys can help. They're sometimes costly, but we've gotten into that situation where we did an elevation survey. Okay, they're up out of the floodplain, even though they look like they are on the map. But it can be a very contentious conversation, especially if the seller has owned the home for 20 years, maybe hasn't had a mortgage on the home for 5 or 10, so they would have had no way of knowing that they are in a flood zone. Because it's not, the mortgage lender is the one that's responsible for telling a property owner that your home is now in a flood zone and you have to have flood insurance.
What percentage of the time do you see variations significant enough between the GFE and the closing figures that requires a redisclosure, and then what impact have you seen that have?
Not as much anymore.
Very minimal.
Yeah, very, very minimal.
When it does happen, what impact is it?
3 days.
3 days?
Yeah, three business days between the event and closing. So Monday, that means you close Friday. So yeah, that's been the main thing.
So if any addendums take place to where a sale price is changing, concessions are added, anything is changing, it's always important to get that over to the lender right away. It's happened to where we find out about a seller concession or some change the day of closing, and then there's problems. But if we can get that addendum, then if we need to redisclose, we have that 3 days to do so rather than waiting until it's a little bit too late. So any addendums that are taking place, just make sure they get to the lender and the title company as soon as possible so that everybody's on the same page with the numbers. And if redisclosure needs to take place, we have time to do so.
Yeah, I agree 100% with that. We had 2 that popped up with 2 days before the closing. We received an addendum from the title company talking about radon mitigation. And it hadn't been done. And it said it would be done, so we had to come to a grinding halt and make sure that it was taken care of. So again, get us everything.
And anything you put on a PA, seller agrees to remove the stump in the backyard before closing. The underwriter is going to put a condition, verify term of PA regarding stump in the backyard has been met. So if during the conversation and during the process, the buyers say, oh, you know, don't worry about it, we'll take care of it if you just give us a $500 seller credit, well, put together an addendum saying the seller credit is in lieu of that, or get it done.
Or even simpler, seller credit towards closing costs and prepaids. It doesn't have to be specifically attached to an item or a process. Just simplify it that way too.
I've had, I mean, seller to fix leaky faucet in upstairs bathroom. Well, then the underwriter wants to have verification and a receipt, and the plumber saying it was fixed, even though you might have been able to do it yourself by going to Lowe's and buying a 25-cent washer. So keep in the back of your mind, whatever's on the PA that I see, the underwriter sees, is going to ask to be verified. And if it sounds problematic, seller to clean up the leak in the basement, well, then you're going to dig it. Then you're going to say, you know, then we're going to get Mr. Yalowski out there, and he's going to have to inspect and verify that the structure's fine, and he's going to have a bill for everybody.
Well, go ahead.
On our new purchase agreements, we have like the notice of objection, and you know, then it goes back and we might ask the seller to repair the leaky faucet. They agree to it, they send back, and it gets done. Does the lender need to see the notice of objections?
It's a gray area. The addenda, we do, because that becomes part of it. Your notice of objection, as I understand it, is not part of.
I mean,
yes.
That's
is that, Matt, what you're.
That's correct.
Yeah.
That is my understanding.
Yeah. So, I guess that brings up another thing too, having to do with underwriting. An underwriter is only going to see what's in black and white in front of them. They're never going to talk to you. They're never going to talk to the borrower. So the more, the better, back to, again, appraisals too, the better narrative you can provide on things, the quicker it will move through the system.
And I think our intent was not to try and hide anything, but to try to not make it more cumbersome, because like you said with the leak, then they're going to say, oh, we better have a plumber out there and make sure that the whole house isn't going to.
And that was my intent for bringing it up, not to tell you to hide something, but use your judgment with what you put on the purchase agreement and as you advise your sellers and your buyers. And then know that if you feel something is needing to go on there, just understand that we're going to have to ask that question. Has that window been repaired? Has that whatever been repaired, and we need to verify it?
Just so you're not going to be able to hide anything too. If something they agree to get fixed, whatever it may be, any of these items we just discussed, if the appraiser goes out there and sees it and it's evident and they take a picture of it, it's going to have to be fixed anyway, and we're going to have to need that verified to be done. So if it is just a little plumbing leak like was mentioned, have them do it the next morning or something before the appraisal goes out there, so the appraiser doesn't see it. You know, just little things like that that would really help keep the transaction moving along.
Yeah, the appraisers aren't usually doing a full-blown home inspection. It's just what's open and obvious to them, and what jumps out at them. You know, there's a puddle of water on the floor.
And you don't have a dog.
So if there was a repair that was done, the appraiser didn't see it, but it was your underwriter knows about it. To verify it, can we take pictures, or do you have to send the appraiser back out and do a re-inspect?
Usually it's the appraiser and a receipt from the contractor.
Paid invoice.
Paid invoice, the electrician, the plumber, the roofing person, whoever it might be.
But the appraiser still would have to go back out?
It's that third party going out and verifying versus me going out with my camera and you taking the picture, which makes sense. But
Sometimes the inspector can, you know, the inspector could maybe go out and send something on their letterhead saying it's been taken care of.
That's a good point.
But
Yeah,
so if the appraiser goes out, generally, there's an extra fee.
Right,
to the
that's what I
buyer.
wanted to make sure.
So that's another good reason to try, and if there is a little bit of peeling paint, or and you know that, and it's gonna be fixed by the seller, have us wait to order the appraisal until that's done. So all the issues that you know about up front are taken care of to save the buyer the $100 or $150 re-inspection fee.
On peeling paint, what is the expectation of reasonability when it's 10 below zero in January?
It's inside, doesn't have to
I'm
do
a
it, but
state,
outside,
yeah.
you usually can do an escrow.
and this is
And usually 1.5 times the highest bid with a minimum of maybe $1,000. So they're gonna make sure there's enough set aside so that once that person does start, if it's more of a complex job, that there's enough to pay.
Is that true for FHA?
And escrows?
Well, certain instances, outdoor.
Outdoor, yes.
Yeah, okay.
Yeah.
But that's where the communication's key. I welcome those phone calls from an agent saying, I have a hypothetical, or I have a situation, maybe it's not on your desk yet, or it may not ever come across your desk, but I have this question, and I'm happy to provide the information. And it's always better when it's in that format than when it's already on my desk and it's something I know about. But if you're calling me on a scenario, and we're not talking about a specific property, we can all assist you with what the best way to address that without compromising what we are supposed to do with compliance and that type of thing. So that's where the time comes in, the early discussions, the exchange of information, and communicating as a team, I think is key on these. I mean, it's real estate, odd things, just when you think you've seen it all, and you've written the book and all the contingencies and everything can happen, you get the thing the next week that's completely unique and you got the problem solved. Yep. And I think we're all problem solvers as lenders because we all want to get to the end. So we take a scenario, we take that loan, we take that customer, and how I approach it, I'm looking ahead, and I don't want to be a pessimist, but I'm always looking to see where my problems are going to be. Where can this thing go off the tracks, and I want to solve them now or get out ahead of them and prevent them. And I know the folks on my left and right are the same way about how they do business.
Any other questions from anybody?
Billy buying lunch? Just don't.
Applebee's, let's go.
Well, one thing I suggest, take this, copy it. There's little lines on there. Give a copy to your borrower. Put the dates on there for contingencies. It can be a very good tool to have everybody have that same thing. After you write your offers, throw that in there, hand it over to them. They've got the same list that you do on what has to be done, what you're shooting for, the closing date, and it's just a good roadmap.
Can you make this electronically available?
Yes. It's already.
That's the one realtors can send out, maybe.
Yep, we'll send it down.
That was compliments of Bill, by the way.
This is Arbor.
So thank you.
Bill's fancy Arbor.
That's my fancy Arbor, oh yes. Well, if we don't have any more questions, I guess we thank you for joining us, and please don't hesitate to contact any of us. We're happy to help.